Welcome to today's video by Rai Tax Consultant for NRIs facing problems selling properties in India. In this video, let's explore the challenges faced by NRIs while selling properties in India and the strategic approach to lower the incidence of TDS through obtaining a lower TDS certificate. I am Chaitnya Garg, your tax advisor. Join us as we demystify the world of finance and empower NRIs to make an informed and confident financial choices. Topic 1. Understanding the complexities. Selling property in India as an NRI can be intricate due to various factors. One primary concern is the tax deducted at source, which is a substantial amount. Let's break down the complexities and discuss the key points to consider. Here are the list of complexities. First, navigating capital gain tax. First on the list is capital gains tax. NRIs are subject to this tax on the profit earned from the sale of a property. Understanding the tax implications and planning accordingly is crucial. NRIs have to pay taxes on the capital gains made from selling the property. Now, capital gains can be of two types: short-term capital gain (STCG) and long-term capital gain (LTCG). Short-term capital gain (STCG) tax rates are applicable if the property is sold within 2 years of its date of purchase and is estimated as per income tax slab rates of the NRI, whereas long-term capital gain (LTCG) tax at the rate of 20% is applicable if the property is sold after 2 years. This brings us to the question as to how do we compute short-term and long-term capital gain. Don't worry, it's not that difficult. The short-term capital gain can simply be calculated by reducing cost of acquisition, home improvement cost, and cost of transfer from the final sale price. The long-term capital gain can simply be calculated by reducing indexed cost of acquisition, indexed cost of home improvement, and cost of transfer from the sale price. Topic 2. Tackling double taxation. As an NRI, one of the significant challenges you may face when selling property in India is the possibility of being taxed in both India and your resident country. This phenomenon is known as double taxation and can lead to a substantial tax burden. To mitigate this, let's explore the role of double taxation avoidance agreements or DTAAs. DTAAs are bilateral agreements between two countries designed to eliminate or reduce the possibility of double taxation. They provide clarity on which country has the primary right to tax specific types of income. In the context of property sales, they often have provisions to avoid double taxation on capital gains. Claiming tax credits. To avoid double taxation, NRIs can explore the provision of tax credits in the resident country for taxes paid in India. Many countries provide a mechanism for taxpayers to claim a credit for foreign taxes paid. This ensures that the same income is not taxed twice, providing relief to the taxpayer. Topic 3. Compliance with FEMA regulations. The Foreign Exchange Management Act (FEMA) regulations play a significant role. NRIs must adhere to these guidelines when repatriating sale proceeds abroad. Any non-compliance can lead to complications, so it's vital to be well versed in FEMA provisions. Topic 4. Operational PAN. If you are an NRI wondering why your PAN card is no longer working despite filing taxes diligently, you are not alone. The confusion arises because even though you are an NRI in the tax records, the system might not have linked this to the mandatory PAN Aadhaar linking. While obtaining an Aadhaar card is not obligatory for NRIs, linking it with your PAN card is mandatory under Section 139AA2. However, the Income Tax Department requires NRIs to update their residential status on the income tax portal, even if they have been consistently filing taxes as non-resident Indians and are registered as NRIs with the National Securities Depository Limited (NSDL). Consequently, numerous NRIs find themselves dealing with the predicament of their PAN cards becoming inoperative. Topic 5. TDS applicable on sale of property. For Indians, a 1% TDS rate is levied while selling a property. However, for NRIs, within 2 years of purchase, 30% of STCG TDS rates become applicable. If the property is sold after 2 years, 20% LTCG TDS rates are applicable. It is imperative to note that TDS rates are calculated on the sale of the property and not on capital gains. Additionally, there is a surcharge as well as education and health cess that varies based on the sale value of property. Even though NRIs can claim the excess TDS refund through filing of ITR, however, it is a time-taking process. If TDS is deducted on full amount, non-resident money will be blocked with the Income Tax Department for a long time, which causes loss of bank interest also. Topic 6. Challenges with obtaining lower TDS certificate. Now let's talk about the elephant in the room, lower TDS certificate. NRIs often face higher TDS deductions. However, there is a way to lower this burden by obtaining a lower TDS certificate from the Income Tax Department. Obtaining a lower TDS certificate. The lower TDS certificate is a powerful tool to reduce the TDS burden during property transactions. Let's explore how NRIs can go about obtaining this certificate and lower their tax liability. First, complete documentation. Second, online application process. Third, role of tax consultants. Fourth, processing time and fees. Topic 7. Strategies for tax saving. One of the best ways to save on capital gain tax incurred from selling the property for profit is to reinvest the proceeds availed into another property. The amount of capital gains can be invested in residential property, and the purchase of new property should be done within 2 years or 3 years from the date of sale in the case of an under construction property. Apart from this, one can also invest the capital gains in capital gain bonds issued by NHAI and REC, but maximum amount invested in these bonds can be Rs 50 lakhs per seller. Conclusion. In conclusion, it is imperative that NRIs keep abreast of the latest tax rules and property market trends. Factors like the value of the property, the holding period, and the reinvestment play an important role in the sale of property by an NRI. It's recommended that you approach a tax consultant to navigate the complexities of selling properties in India, as an NRI requires careful planning and understanding of various tax implications. The lower TDS certificate is a valuable tool to lower TDS incidence, but it's crucial to approach it with the right knowledge and documentation. Thank you for joining me today. If you are an NRI planning to sell property in India, take these complexities into account and consider applying for a lower TDS certificate. It could make a significant difference in your tax liabilities. Until next time, stay informed and make wise financial decisions. If you have any further queries or clarifications, then please feel free to call on the below given number.